inflation numbers are they focusing on? Let's try and answer that question. Bilal Hafeez, Macro Hive CEO and Head of Research, joining us now. Where do you think the ECB's focus should be? Headlines starting to roll over. Food prices, though, look very, very elevated. And core remains quite sticky.
Yeah, I mean, in my view, I think they have to focus on core inflation. You know, we all know the energy story, and to some extent that's out of the control of the central bank. But what we know from the US and other countries, you do get this handover from headline to core, and core remains stickier than otherwise people would think. So I think they should focus on core. There is a big debate within the ECB. You have the doves, like the chief economist Lane, on one side, who are basically saying that you can look through a lot of the stickiness in core inflation. Then you have others like Schnabel, who basically say, no, it's sticky, and, and they should be hawkish. So I think they should focus on core. I think they should be hawkish, but we'll see which way they go in December.
Well, hey, it's Alex. Good to see you. So to that point, if we parse it a little bit, you have Lagarde saying want to get back to 2% inflation in a timely manner, and then the really big hawks as quickly as possible. What's the distinction between timely and ASAP?
That's a great question, and I think none of us really know, to be honest, and central banks themselves don't really know. I mean, central banks have moved from trying to predict inflation to saying they're data dependent. Now the question is, which data are they dependent on? Is it headline? Is it core? I think they don't know, and to some extent, this is the first inflationary phase we've been in since the 1970s, so I don't think many people are equipped. My bias would be that they should err on the side of caution to try to tamp down inflation, and so try not to.
What does that mean? Is that 75 next time?
I think it means 75. Yeah, I think they should go 75. The market's pricing more like 50, or it's veering that way, but I think they should go 75, act aggressive. Remember, their policy rates are still at 1.5% right now, and inflation is between 5 and 10%, depending if you look at core or headline. So they're way behind the Fed, and so they need to accelerate the hikes, just like the Fed did. The Fed did several 75 clips before they started to think about 50, and I think the ECB is very early on at this stage.
Bilal, do you like the euro and European equities if we get 75?
No, well, not equities, at least. I think we've had some really great news for equities over the past few months, for European equities at least. We've had the China reopening story. We've had a relatively mild European winter. And so if they do get 75, that could be the thing that could end the rally in equities. On the currency side, I'm a bit more neutral, because I think that, on the one hand, 75 would be good for the euro. But on the other hand, I do think that the market is a bit too optimistic on the Fed pivot, which could help the dollar then. So I'd be on the euro, I'd be more neutral on the euro.
We're going to see Emmanuel Macron going to, I think he's there already, actually, going to DC. He's going to meet with Biden tomorrow. That's why I'm thinking about it tomorrow. He's annoyed at the Inflation Reduction Act. He is really quite cross about it. He thinks that European companies should be buying European. He thinks the US needs to back down on this. He thinks that effectively the US is starting a trade war. Can the Europeans really, given the energy crisis, given everything else, afford to start a trade war with the US right now?
No, they can't afford to start a trade war, but the US has actually started a trade war. And I think this is one of the unexpected side effects of the Inflation Reduction Act, which is that, in effect, the US is basically saying that US production will be massively subsidized, and that will disadvantage European companies, especially electric cars. So now Europe, at the same time, is massively dependent on US energy, so they don't really have, they're relying on that, so they can't argue with the US too much on that front. Then on top of that, the Europeans don't necessarily have a cohesive policy amongst themselves on how to relate to the US. On the other side, the US is picking a fight with the Chinese on chips, and Europe is in the middle. So Europe hasn't picked a side. So the US could say, look, we'll give you some exemptions on the green technology subsidies, but in return, you have to turn against China. So there'll be some tough choices that Macron will have to face up to with Biden.
Do we need to price any of this in? I mean, that sounds like a really, really, really thin road of agreement that they can get, particularly if it comes sort of hardlining Europe against China, particularly Germany.
I think we do have to price this in. I mean, timing is a bit trickier, but on a 1 to 2 year basis, I think this is very, very negative for Europe, because Europe, on the one hand, is facing much higher energy costs on a long-term basis, notwithstanding the current mild winter. But also, the US is tightening the screws on Europe with its relationship with China. On top of that, the US is massively subsidizing its own production onshoring. So that really leaves Europe stuck on its own. And it really brings into question whether the German industrial model really is fit for purpose right now.
Can I read something interesting on your website. I'm wondering whether I should have read it in Turkish. And here's the reason why. You're making an argument that high inflation is high rates are basically causing high inflation. Now, I sat just about over there once talking to President Erdogan about the same sort of argument. But walk me through how you're approaching this.
Yeah, essentially our argument was that we've had a long period of low interest rates, and one thing that did was that it allowed lots of loss-making companies like your Ubers, your DoorDashes, Deliveroo, Disney Plus, all of these companies are selling us products that are loss-making, i.e. they're offering lower prices than it costs to offer that product.
Yep.
And that was because they had low interest rates, so investors were happy to pile money into these sorts of companies. Today, as the interest rates go up, those investors run away. So all of these companies will have to raise their prices in order to stop making losses. That means taxi prices through Uber will have to go up, Deliveroo, DoorDash prices will have to go up, Disney Plus, if you subscribe to that. They make $4 per subscription per month. It costs them $20 per subscription. They're able to, in the past, they funded that through low interest rates. That's gone. So there's lots of things that have, lots of prices that have been low because of low rates. And so paradoxically, high rates could actually lead to higher prices going forward.
And that is a solid argument for that link. Hey, Bilal, you're going to stick with us. Bilal Hafeez, Macro Hive CEO and head of research, will be staying with us. We're going to take a look more at some geopolitical risks.
A bit further. Bilal Hafeez from Macro Hive, still with us. You were making the point in the last block, talking about the idea that Europe ultimately will have little choice but to step away from its relationship with China. The US is going to insist on it. Biden administration making it very clear that the firm focus remains China. As we see that fragmentation, can you just walk me through the ripple effect, the impact that is going to have?
Well, I think the biggest effect will be on Germany itself, because if you look at German trade with China, the Germans export massively to China, and they also import a lot from China as well. So to some extent, Germany is quite embedded in the China global supply chain. So for them to extricate them from China will be very, very difficult. On top of that, more broadly across Europe, the Dutch produce important inputs for chips that go to China. Italy is a big exporter of luxury goods to China. So it's hard for Europe to extricate itself from that. So that's going to be one very, very difficult challenge that they have. The other side of all of this is on the energy side of the picture, because what's interesting with Europe is they are facing much higher energy costs. And if you look at German industrial companies in particular, many of them now are shifting production to China, where energy production is cheaper as well. So there's an energy issue of where should the Europeans base their production facilities. Now, the US is obviously saying come over here to the US. The China is saying coming over here to China. So there's the China export market, but there's an energy problem as well. So for me, these are the two big challenges that Europe has.
I actually didn't know that about the energy part. That seems just like substituting one for the other. What do you do with China right now? Like, how do you model China for next year in terms of reopening and zero COVID policy, support from the government?
I think it's very difficult. I mean, in essence, as you say, it's a binary. Are they going to reopen or not? If they are going to reopen, then that will see lots of China growth-sensitive markets go up a lot, whether that's commodity prices, Chinese stocks, and so on, as we've seen in the last few days. At the same time, we know from the example of, say, Taiwan, when they reopened, you saw death rates skyrocket. So Taiwan's death per capita now is similar to other countries like Korea or Japan, whereas previously Taiwan was held up as an example of how to manage COVID. So China ends up facing a similar acceleration in deaths, then that could suddenly question the credibility of the government. So the path to reopening is not clear-cut. But at least markets, at least, are viewing this as a binary, reopen or not. Reopening is good for markets. And
if you get that call wrong, how big an impact is that going to have on your 2023 performance, do you think?
I think it will have quite a significant impact. If you get that call wrong and they don't reopen in the way that we think, then stocks will not perform so well. The rest of the world equities won't perform so well. One of the biggest consensus views you have going into 2023 is to buy international stocks, non-US stocks, and sell US stocks. So all of that unravels if the China story isn't there.
What is your top 2023 call then? Like, what do you have the most confidence in?
At this stage, I would say that I think people are too optimistic about 2023 in terms of risk markets. I still think we're in this environment where we're going to see some serious risk unwinds in the course of 2023. So I think people should still be very defensive. I think people are too optimistic about the Fed pivot, for example. But more generally, I think people are underappreciating the types of tremors and earthquakes we'll see in markets as you move from low interest rates to high interest rates. And I think people are too quick to dismiss that as a risk to overall markets.
The last couple of times I've seen you, cash. That's been your kind of central call. Are you still on that front?
Absolutely. I still think cash is the best asset to be long in. It preserves your capital. On top of that, it gives you optionality for when markets do go into distress mode. On top of that, if you go back to the 1970s, cash outperformed equities, outperformed bonds. So I think it's still wise to be very prudent, be long cash and be very defensive. And tactically, you can go long here and there. But overall, I think 2023 won't necessarily be such an easy year.
Bilal, is there something that makes you change that view? Like, is there a moment or something binary that you're like, okay, that's the moment where I'm going to change and get more aggressive on risk here?
Yeah, there's a few different things. I think one would be that if we were to see a change in the US inflation dynamics, so one example, which is a bit more left field, is if, for example, the Fed said we're comfortable with 3 or 4% inflation. So in essence, if they changed their inflation target and they said actually 3-4% is fine, so we aren't going to drive interest rates too high. So I think in the short term, that could actually be quite positive for risk markets. There is more kind of chatter around this possibility. The other side of all of this is, and this is much more difficult to handicap, is whether there is some kind of productivity boom that's going on in the US or not. There's a lot of capex that's been occurring. It hasn't quite shown up in the productivity numbers, but if that was to happen, then suddenly the growth numbers for next year look a lot better. So I think that could be the other thing that would change my view.
Awesome. We just love you. Bilal Hafeez of Macro Hive. He's sticking with us. We're going to get his thoughts on crypto coming up next. This is Bloomberg. Kraken, which is a crypto exchange, is reducing its workforce by about 1,100 people. That's about 30% of its workforce. In some ways, this comes as no surprise. In other ways, it's just, the nail keeps getting hammered into the crypto industry. Let's get more on this with Bilal Hafeez of Macro Hive. What is your take on what's happening in the crypto market right now? Like, where does the bottom stop?
That's a good question. And to be honest, I'm not sure where it stops right now. I think one of the ironies, I think, that is that crypto, or Bitcoin at least, was created in the aftermath of the global financial crisis because people worried about traditional finance banks from failing. And ironically, the first financial system to fail after the GFC is the crypto financial system. And I think FTX, which in essence was a broker-dealer / exchange, has failed. And lots of the other entities, financial or crypto entities linked to it, is also failing as well. So the challenge right now is we've gone from a phase where crypto was selling off because equities were selling off and interest rates were going up, to now people are questioning the entire infrastructure of crypto as well. Not only that, but lots of credible names that had attached their credibility to lots of these different entities and tokens are also suffering as well throughout all of this.
Are you surprised how little due diligence was done? Nobody seems to have expected any of this, at least on this scale.
Absolutely. I'm stunned, to be honest, around the lack of due diligence. If you look at the list of names of investors in FTX, it's some of the top investors in the world, from VC to sovereign wealth funds and so on. So it's really quite stunning. And it tells you that when you're in a bubble or when there's FOMO, people just want to get into the deal. And even if that means not looking at the underlying data. It's interesting now. Anybody in traditional finance, when you look at this, it looks very obvious. But perhaps one issue is that people suspended their normal analytical skills when it came to crypto.
Bilal, do you think that the contagion is done yet?
No, I think there's probably further to go. I mean, normally, if you look at traditional bank crises, normally what ends it is you need to either see some combination of a regulator coming in some form to stabilize the market. So we haven't had that yet. Or alternatively, you need to see the value of the assets and the institutions in crypto to go to a price that is extremely low. And I don't think we've got to that point either. So I think it's too early to say that we've come to the end of this. Is
the Bilal Hafeez Grey Swans top 10 or whatever it is that you produce every year out yet? It's coming out next week, actually. And we've got some really good ones there that will really surprise you. Okay. Surprised me when some of the authors wrote it. Okay, fantastic. We're going to get him back. We're going to make sure we have a look into those. As we run up to Christmas, always a nice way of looking at the year ahead. What could potentially happen? Not black swans, because we don't know what those are. Grey swans, maybe. Bilal Hafeez, Macro Hive CEO and Head of Research. Great stuff, as ever. Thank you very much indeed. Let's take a look at where European equity markets are trading coming in.